What you're about to experience is one man's quest to see beyond the tumultuous period we're in and to envision what lies just beyond our grasp, yet well within our reach. Welcome to Larry Rifkin's America Trends, where the future has arrived, and it's just in time.
Welcome back to America Trends. I'm Larry Rifkin, and along with me, always in the, what car do they call it? Remember there used to be those little seats in the rumble seat? The rumble seat is John Krosick rumbling away. And John, we got ourselves a brand new spanking tax law in America.
Yeah, I see
How
that.
excited are you about that?
I don't know. I'm waiting. We'll have to wait until next year's tax season to find out.
Well, I'm sure your paycheck now is bulging as a result of this.
Yes, well, yes, it's bulging.
You know what I have that's bulging? I've got a George Costanza wallet here. And it's not because of money. It's because of all the other stuff.
All those IOUs in there.
What I don't understand is how anybody who has, 3 credit cards and has a bank card, a Costco card, a license, how do they get these things down? Or now that I'm on Medicare, I've got 3 cards, the supplemental.
Right. The government has
the
to
whole
have
thing.
all their cards.
No, but seriously, how do people not have George Costanza wallets, John?
I don't have a George Costanza.
Well, then what do you have in yours?
I just got the same thing. I think I got 1 credit card, my driver's license.
Yeah.
And
but wait, you only have 1 credit card.
1 credit card.
I've got a couple.
Yeah.
You have a Costco card?
I do. I have my Costco, and I have a BJ's card.
All right. So you've got a couple of cards.
Yeah.
You have one for health insurance.
Health insurance, yeah.
How about your Social Security card? Or
no, I don't carry that.
Nobody
No,
cares.
that's
Just
that.
testing.
Yes.
Just wanted to make sure. Well, at any rate, we'll get away from that because this tax law has nothing to do with the size of your wallet. Well, maybe it does, John.
Well, for people who have really big wallets, it's going to affect them.
Now, John, you know that I have been poring over countless documents to prepare for today's podcast.
I'm sure you have.
I've been checking with Nobel-winning economists. I even checked with the guy who holds the Liberty Tax Service torch on the corner during tax season to find out if he thinks this is good.
Hey, that was a good one.
I'll tell you, those people, I wave to them. I really, hi.
I beeped the horn away.
Yeah, hi, how you doing?
I mean,
I know.
I wouldn't want to be out there.
What do you think that person makes? Enough to even claim any of that income?
Well, he probably, if you walk in there, he probably does your taxes.
The same guy. It's just like when you go to one of these drugstores and they tell you they do flu shots and pneumonia, and you say, I don't want that pimple-faced kid in aisle 4 to do my shot, okay? Do you have anybody who knows what they're doing? Well, listen. We are doubling the standard deduction for those who file the short form, and that can't be terribly bad. We are getting rid of the alternative minimum tax, and that seems to be a good thing because, John, that began to swallow up a lot of people who were unsuspecting.
Yep, I agree.
So those are good things. And bringing money back, a one-time deal to get it from offshore to American shores, that's not a bad thing, too.
And it seems like people have actually benefited from that. People have gotten bonuses and stuff.
Well, what I'm thinking is, honestly, and part of that is driven by the gentleman that we're bringing to you in just a couple of moments, that I don't think that this new tax law is as bad as the Democrats say, but it's not the holy grail that the Republicans say, because it's not that you just can do your taxes on a postcard. It's not totally simplified.
Yeah.
So I think both parties are making a little bit more out of this than, in fact, the facts.
I agree. I think, in fact, I would have been happy if we went to some sort of flat tax and everybody pays their part and have no connection with the government.
Well, that's what a lot of people really considered real tax reform to be. That's something that really takes the current system and turns it upside down. And it's not that. That's not what this is.
I mean, they've simplified it, but there's still stuff in there that
they didn't take out all the exemptions, all the loopholes.
Exactly.
They didn't do that. Now, for those of us who live in a blue state, They did take away the ability to take your state and local taxes and put that as an offset against your federal to a certain point. Up to $10,000 you can. And we know that we're here in Connecticut that does not really comprise the entire load that we have for our state and local taxes. But having said that, there are some other benefits in this plan that may help to offset the federal obligation. And that's what we wanted to do, John, with this podcast. We wanted to make certain that people don't know part of the story, that they know the rest of the story.
I agree.
And it's not a simple thing to figure out what the impact is. And there are clearly going to be some people paying more, but there are going to be a lot of people hopefully paying less. Now, one of the things that bothered me, and you know I'm a debt hawk, and I don't want to increase the federal debt. I'm hoping that some of these grandiose projections really do pan out so that, in fact, we're not adding to the debt.
I agree with you there. I think we can't leave this debt for our children and their children. I think we got to address it at some point, and I'm hoping that they do, or that the economy comes back so big that we can deal with it.
Yeah, exactly. I mean, that is the hope. But let's turn to Steve Malanga of the Manhattan Institute. He studies state, local taxes and their impact on communities as a living. And we have turned to him many times, you and I, in our radio days and podcast days, and he always comes through. So why don't we hear him about this new tax law and, in particular, the impact on different communities and states.
Sounds good.
All right. Steve Malanga is with us once again on America Trends. And Steve, I wanted to bring you back because you're an expert, of course, on state and local finance. And I'm just wondering about the impact of this congressional plan now adopted and signed into law by President Trump that relates to taxes, because the state from which I am emanating today is a state that is crying that we're going to get killed by this because of this exemption that has been lost for property taxes and sales tax and income tax. And I know there's a lot of screaming going on in many of the more high tax states that do have income taxes. But the more I read about this, the more I'm convinced that there are many offsets to what it is that they are concerned about in this plan.
Okay, so I'm going to start off by saying I think you're right. And I think, not more than I think you're right, you are right. First of all, one of the problems is I do think that a lot of the reporting on this, particularly in those states that are affected by the ending of the state and local tax deduction, tended to be one-sided. What I mean by one-sided is this. There was a lot of reporting on what you would lose, but not a lot of reporting on what you were going to gain. And the offsets are very important. I'll tell you what I mean. Okay, you're losing your state and local deduction, but I actually did a search in a newspaper database. This was stories written about New York State, which is going to actually, there's a lot of screaming about New York State, too, as you can imagine. There was one case where there were 70 stories were written, published in New York State by newspapers about what you would lose. Only one of those stories mentioned that they were basically going to X out the alternative minimum tax for most people. Many people in New York State pay that tax, and what that tax does these days, it was originally passed in the 70s targeting rich people, but over the years it wound up encompassing more and more middle-class people. And one of the things that tax does, and people don't realize it, is it essentially limits your tax deductions anyway. So many people, as I've said over and over again, if you go look on your tax form and you see that you've paid the alternative minimum tax, you're almost likely not going to be paying that. That's a tax cut. And what people don't realize is that tax, the way it was figured, the complex formula, it basically said that at a certain point we're going to limit your tax deductions anyway. So the current system was already doing that. Secondly, of course, tax rates are going down. And the other big point, of course, is that they are essentially doubling the standard deduction that you can claim. It's going to, and the funny thing about this is that many people won't even be deducting their state and local taxes anymore under this system, because the doubling of the standard deduction is fairly significant. Now, here's the thing. If you are very rich and you are in these states, you are going to be paying more in taxes. There's absolutely no doubt about that. But the idea, let me give you an example. A colleague of mine was hosting a forum in Manhattan and asked people, how many people thought they would be paying more taxes? Almost everybody at this forum raised their hands. Now, the New York City Partnership, which is a business group, actually did a modeling of this for this whole tax reform for individuals in New York. What they concluded is that almost everybody earning up to $500,000 a year would get a tax cut. Once you get above $1 million a year, you're going to start paying a bit. When you get above $15 million a year, it's a tremendous hit. There's no doubt about that. So people making $15 million a year, households, could pay approximately in New York State $250,000 more in federal taxes than they've been paying. But you know how many households there are in New York State that claim income of more
But
than
isn't
$2
that
million?
what a lot of people want, is more progressivity to it?
Well, see, this is the irony. What I say is what the Republicans did is, in order to give a lot of people a tax cut, they basically stole a book from the Democrats and said, let's tax. We'll by Xing out this standard deduction, we'll tax the rich, and then we're going to take some of that money and we're going to apply it in all these different ways. So that they stole a page, essentially, from the Democrats. They actually did, in one respect, make the system more progressive, but not by raising rates, but by eliminating deductions. Any time, of course, you do any kind of a tax reform, what happens is there are always winners and losers. Mm-hmm. They basically made the losers rich people in high tax states. And the irony of this, of course, is that if you look, not so much in Connecticut, but certainly in California, New Jersey, and New York, that's the kind of system that the states have enacted themselves. California's income tax is extremely progressive. If you make over $1 million, your tax rate, your California tax rate is at 13%. In New York and New Jersey, it's about 8.5%, give or take a half a percentage point between the states. So there's a very big difference in those states, and what has become fashionable basically in those states is not to raise taxes on everybody, but to raise taxes on the rich. So essentially, the Republicans in Washington stole a page from the Democrats in this respect. Now, the other thing to think about is there were clearly going to be people in Connecticut, to take one example, particularly wealthier people in the wealthier communities who are going to be paying more because the lowering of the tax rates and the ending of the alternative minimum tax, or the phasing out of it, basically is not going to offset how much they were claiming in deductions. But here's the thing. One of the more interesting things is that in the Northeast in particular, where you have Connecticut, New Jersey, and New York, all bordering each other, you're going to have a kind of what I call a more intense regional tax competition, if you will.
I agree.
Because, this is not, everyone's talked about this in terms of, there are even some articles that said, the South is going to benefit tremendously from this because, it's going to increase migration. And I agree, when we talk about increasing migration, I don't really see the numbers being big, but what I see is among the very rich, certainly if your tax bill, if you were contemplating, as it is, whether or not you're going to move your business, let's say if you're in financial services, out of the Northeast into a place like Florida where there's no income tax, and now your tax bill is going to go up by $250,000 a year, that's significant. It's one thing to say we're going to raise your tax bill a couple of $1,000s a year, and ask whether people are going to migrate because of that. Now we're talking about $250,000 increase. Those kinds of people, may actually do that. And this is where the progressivity of some of these state taxes is going to matter. Because, again, I was talking about people making $15 million a year or more in New York State. There's only about 2,500 households that earn $15 million a year or more. However, they pay 1/3 of the income taxes that the state government collects in New York State.
No, that's really interesting and an important piece of information, because I think people would be stunned by the impact that just a few individuals can have in various states. But to your point about the competition, Joe McGee of the Business Council of Fairfield County in Connecticut said, if you need to live and work in the tri-state area, Connecticut's marketplace appeal is enhanced, even if many of us are paying more with this tax law. But I just want to go back to the alternative minimum tax. Did I read this correctly, that it began to ensnare people at about $150,000, $160,000.
Yes.
Now it's going up, that exemption, to $1 million.
Yes, exactly.
That's pretty substantial.
And here's the thing. This is a glass half full, a glass half empty. Because if I had asked for the perfect tax reform, the first thing would have been to get rid of the alternative minimum tax. It was never a good tax. What it was in the 70s, there were actually some stories about individuals, very wealthy individuals, who had managed to almost completely eliminate their federal tax bill. And there was actually a treasury secretary at the time who, after he left office, talked about this. And there was so much outrage that they instituted this in order to limit the amount of deductions and loopholes that people could claim. Over time, what happened was, as the federal government needed more money, they basically extended who had to pay this down into the upper middle class, and then the kind of the middle class in some places, depending upon how many deductions you had. And so, what happened was, as you said, it was hitting quite a lot of people, particularly in states like New Jersey and New York. And the only reason it existed was to raise more money for the federal government. It had lost its original, intent, was to make sure that rich people didn't exploit all the loopholes. So I would have preferred that they completely got rid of that and just flatten out the tax system. They didn't do that in the end. Again, they kept it, but for the rich. But the good news is that that's something that is going away. And I always, whenever I talk about this, particularly if I'm talking to people in the Northeast, I say, did you look at your income tax? Because a lot of people, their taxes are done by their accountant. Did you look on that second page where it says alternative minimum tax? Do you have a couple $1,000s in that you've been paying that you don't even realize you're paying it? Because that's probably going to go away, depending upon who you are. So that was actually, in my opinion, very important, because that was just one of those taxes that over time, one of the reasons people sometimes object to new taxes is because over time, once they exist, they can be extended by the government to essentially target more and more people, simply to raise revenue.
Yeah, the creep, if you will.
Exactly.
I mean, let me ask you this, Steve. Do you see, and then I want to get into impacts on the states themselves and localities, because I think there are a couple things hidden in here that I really want to get your expert thoughts about at this point, as we are now in some reality about this. It's going to take effect, very, very soon, and affect everybody in calendar year 2018. But the idea that there's going to be a demographic movement as a result of this, from blue states and higher tax states to some of the lower states in terms of their local and state impact. Do you really see a lot of demographic shifting that will take place as a result?
Well, a couple of things. First of all, simply as a result of this, no. But what the governors are really worried about, although they don't say it in these terms, express it in these terms. Rather, they do tend to, express it in the most politically, appealing terms, which is, this is going to be terrible for everybody out there in our state. what they are worried about is a few key rich individuals leaving. Let me give you an example. In 2016, the richest guy in New Jersey, a hedge fund operator in New Jersey by the name of Dave Tepper, took his entire operation to Florida. Now, it was reported that Tepper was paying more than $100 million in state income taxes alone a year. You get a couple of people like that moving.
Yeah. Okay.
and that makes a difference on the budget. And I think that's where the actual worry is for a lot of people. The other issue in all of this is that they are also, of course, limiting the mortgage interest deduction for very wealthy people. And in a lot of these places, you have higher than average home prices, and to a certain extent, those have been justified over the years by people because they got this complete break on their mortgage interest, and that is going to be limited. And so that might, again, at the higher end of the market, it might limit price increases for a while. You can have a debate about whether that's a good thing or a bad thing, but there's probably going to be some impact of that function. But in general, also, home prices are very much dictated, much more so, of course, by the state of the economy. And I would say that a little bit of restraint in home prices, could serve to limit the next housing bubble, which is, in my opinion, we've got sometimes too much volatility almost in home prices. It's one thing to have a volatile stock market. It's quite another thing to have a volatile housing market. And I think ours in America tends to be more volatile than places like Canada, certainly, where they don't have things like the mortgage interest deduction. And there's been an argument for years that restraining the volatility of the housing market is actually a good thing.
We'll return to this episode of America Trends in just a moment. If you like what we're doing here at America Trends Podcast, please don't keep it to yourself. I know there are a lot of people, John, who think, well, if I'm listening and somebody else wants to listen at the same time, maybe we're going to collide and they're not going to be able to hear us. Yeah. Is that the way the technology works?
No, there's plenty of bandwidth. Everybody can listen at the same time.
All right. Well, that dispels that myth. Now, you can do a number of things that would really be helpful to us. You could give us a kind rating or a review at Apple Podcasts, and that boosts what they consider to be our value and visibility. And what does that do, John?
Well, that puts us in the forefront so that you can find us easier, and most important is other people can find us easier.
And you can subscribe there or on our site, americatrendspodcast.com, or wherever you're listening, so we can alert you to new episodes of the podcast, which, by the way, we put out twice a week on Tuesdays and Thursdays. And stay in touch with us on both Facebook and Twitter at Trends Podcast. Or you can like us on Facebook or follow us where, John?
On Twitter.
On Twitter, that's right, where the world turns to hear fake news or whatever it is. Well, you can direct message us at Trends Podcast or using hashtag Trends Podcast. And John, with our growing audience, and really it's been pretty remarkable, a lot of people just came to us the last month or two, and they might have missed earlier episodes. Can they get them again?
They can look through them and pick the ones they want to listen to. They're all on the website, and a lot of them are up on iTunes, many of them.
All right. Well, listen, there's lots of material to listen to. We hope you have the time, and will lend it to us because we try to make it worth your while. And thanks so much for listening.
And tell your friends.
We now return to this episode of America Trends. Now, let's talk about the states themselves. There's something that's been underreported, and that's the expansion of the 529 savings accounts and the partial elimination, of course, of the state and local tax, which we have talked about. But when we think about it, many are saying that this is going to be a blow now, this 529 college savings accounts coming down to cover K through 12 expenses for private school tuition and homeschooling costs. Some say that's going to take it out of the mouths of the public schools and bring it over for wealthy people to use as another deduction for private schooling and pushing, again, the poor into the only practical thing they can do, which is to stay within the public school system. How do you look at that?
Well, one of the ways to look at that, first of all, because again, this becomes such a politically heated and partisan discussion. One way to look at it is to look at the people who have a stake in this in a way that's nonpartisan. And what I mean by that is I've looked and read some of the commentary on this by the financial houses themselves that offer 529s. And one of the things they're saying is we don't know what the effect is going to be. We think it's going to be very limited. There are a couple of things. You talk about, again, this is something that their sense is the very rich might take advantage of. And therefore, it might make it easier for them to pay for private schools. But that just suggests that maybe a few more people in very rich communities who are now sending their kids to public schools might send them to private schools instead, might opt to make that decision. It might be like a trigger for them. But these are communities where the schools are very well funded already. Although the Democrats talked about how this is an assault on inner city public schools, I don't understand how that's the case, because unless there's something really unanticipated happening here, this tax deduction is certainly not going to be enough for most lower income families to save enough to send their kids to private schools. There are charter schools out there that require some kind of commitment by the parents, but they're usually pretty modest. And I don't see lower income parents who will be getting this standard deduction like the rest of us, which is, again, this enhanced deduction. I don't see them even saving enough money by using the 529 to itemize, right, their income taxes, because they're going to get basically a family. They're going to get a $24,000 deduction as it is automatically. The only reason you would itemize and claim these different deductions would be essentially if you were going to claim more deductions essentially than the standard deduction.
Right, the 24,000. But what about the 465,000? Let's take that group, because you looked at New York earlier when we talked about the SALT changes. New York private school students, that would take about $3 billion, at least by one projection, from New York's income tax base. Now, what pressure might that put on towns and cities, or is $3 billion kind of a drop in the bucket when we're talking about New York State?
Well, again, I'm not quite sure where those projections come from. But again, by expanding this, they're going to make it easier for people with 529s to withdraw. Okay, people who've been saving for college and use it instead for something like high school. But in order to do that, okay, you've got to feel secure that you've got enough for college. And now you're going to go down into kind of into a private school for your kid, private high school, let's say. Even the people that run these accounts, the financial services, they don't anticipate a flood of money into the 529. So I don't really see how this takes money out of the public education system unless many people move essentially to use this money to get their kids out of the public schools. And I just don't see that, particularly because, let's face it, in places like suburban Connecticut and New Jersey, where people tend to be happy with their suburban public schools, and they're paying property taxes to get those schools in the first place. So I've yet to see anyone in financial services anticipate a flood of money into these accounts, which means that you're not really getting, you're not really getting a substantial inflow of potential money into the private schools at the K through 12 level.
Okay, now, with the partial elimination of the state and local tax deductions, as we call it, SALT, what about the notion in some of these states where there will be great pressure from towns and cities not to raise taxes, because people are now looking at this and saying, well, I can't even write this off on my federal tax. Now, we know a lot of people are going to be doubling, their standard deduction, so there are mitigating factors, but the pressure that might put on states to either have more money coming from the state level to help some of these communities. Do you see that as a likely scenario in all of this, or no?
Okay, so here's the thing. This is, now we're talking not about, rational economics, but rather how people respond to how people's behavior change because of what they perceive. On the one hand, there's very clear evidence that the Tax Policy Center in Washington, which is a nonpartisan group, I would say somewhat left-leaning, but they're certainly center-left, center-right. They anticipate basically that 90% of income tax filers are going to get a tax cut, okay, with this. The question is this, once this rolls in 2018, people see what they're actually getting, and again, there's, as we've both discussed, there's a belief in many of these states that they're going to be paying more in taxes. Once they see that they're not, then the question becomes, how do they react, essentially, to the fact that they can't deduct their property taxes? Because even in high tax states like New York, New Jersey, or Connecticut, essentially what's going on is more than half, well more than half of property tax of homeowners who are paying property taxes are still paying what would be considered modest taxes across the board. It's the top 20 or 30% that we're really worried about, that they're paying so much in property taxes that they're going to look at this and see that they're essentially taking a loss. So the question becomes this: if I get I'll take myself. If I get a tax cut next year and I got more money in my paycheck every year, okay, and my property taxes go up by 4 or 5%, the way they tend to do in a lot of these high tax states every year, or we actually have a cap in New Jersey now at 2.5%, 3%. New York has a nominal cap also. Am I going to object to the fact that I can no longer write off that extra 2.5%, or am I going to say I just got a federal tax cut? I don't know how people are going to react to
I
this,
understand
whether
what
they're,
you're saying.
Whether they're going to even, in other words, put 2 and 2 together.
Well, let me put you in the position of a psychologist again. And, I just got a request from an individual who runs a nonprofit here in my state, and he does great work. He really does. And he talked about a significant cut that he already took from the state. And so he's worried about that. I just, made a donation. But the impact on donations, and I'm not certain where the charitable dollar really comes from in general, but if a lot of people are going to be taking the standard deduction and will not be writing off charitable contributions, if they're giving to fewer nonprofits, and by the way, in our state, lots of people are looking at nonprofits as being a more effective way to deliver social services, could that, in high tax states, affect what it is the state can do, or what is going to come back to the state at a higher rate in terms of performing certain services if people begin to withhold some of their charitable giving? Is that a likely proposition, or am I just speculating where people's psychology may go in this realm?
No, you're not. Let's explain this, okay? So they did not eliminate the charitable deduction. There have been proposals in the past, essentially, to eliminate all deductions, including the charitable deduction. That was always an unpopular one because you're essentially giving to charity. At various points when it's been proposed, essentially, to consider getting rid of it, some of the experts have said, look, if people are going to give, they're going to give. If they're just giving for a tax deduction, is that right to essentially manipulate the code in that way? But they kept the deduction. Now, even keeping deduction, there is not an unintended consequence, but there is a consequence, and that is by giving us something. And what they're giving us, of course, is they're doubling the standard deduction. they're going to vastly decrease the number of people who itemize their deductions. I forget what the actual number is, but I think about 28% of all Americans itemize right now. Okay, the truth of the matter is, the charitable deduction only matters to those 28% who itemize.
Mm-hmm.
Okay, right now. So, but now this is going to be reduced even further. I think I've seen like maybe 50 to 60% fewer people would itemize. I don't remember off the top of my head. Okay, so the more people we eliminate who itemize, the less important the charitable deduction becomes. Okay, because it's part of the whole package.
Mm-hmm.
I mean, one of the great things about the charitable deduction under the current system is that if you were paying the alternative minimum tax, which we talked about a little while ago, or if you were paying that, that alternative minimum tax X'd out your deductions, but one of the deductions that didn't X out, or reduce or cap was the charitable deduction. So the charitable deduction was always one of those things that, like my accountant would always say to me, you get full value, full benefit for the charitable deduction, right? All right, but now...
Get to Goodwill. Do it today.
Yeah, right. But now what we're doing is, because we did this good thing in terms of tax reform, we doubled the standard deduction for everybody. In the process, we made the tax code simpler because far fewer people are going to itemize. Most people will be able to fill out their taxes in this new system just using 2 pages. Because we did that, okay, we also made the charitable deduction less important. I don't know how people are going to react. We're going to find out how people will react to that. But now you got to step back and say to yourself, it's not like we did something bad. Okay, we did what we've been trying to do for a long time. We reduced the loopholes. We increased the standard deduction. We flattened out things a little bit. I would have liked to have seen the tax rates flatten a little more. But in the process of doing that, I mean, should we have retained all of that just so people keep giving, take advantage of the charitable deduction? I mean, think about that.
But I do want to know what the impact is on states and delivery of services if that does come to be. But we won't know for some period of time, but we wanted to put it out there so that people are thinking about this if they begin to hear that in the public dialogue. Let me ask you one final question about this whole area. We know there's going to be more debt put on the federal government as a result of this, even with dynamic scoring and so forth. It's going to take a while for that growth to kick in, if it does kick in. But what about more debt as it relates to the federal government? What impact will that have on states?
Well, I think there's a couple of things. One of the things I would say, when we often talk about tax reform in terms of, for years I talked about tax reform that would be revenue neutral, simplify the system, get rid of the strange incentives to do things to do things just because you're getting a tax break. And frankly, we could have done that and made it revenue neutral and just cleaned up our system. Instead, essentially what the Trump administration did, or really what Congress did, is this was a tax cut that included some tax simplification. And but here's the thing, and here's what I think is valuable here. For the last 8 or 9 years, we have had essentially the worst economic recovery since World War II. In terms of state and local taxes in particular, one of the reasons states are complaining so much is we are 8 years into a recovery right now, and it has taken states twice as long to get back in terms of tax revenues to where they were in 2007 than it has taken in the last 4 previous recessions. It's been extremely slow. And the reason it's been slow is because you've heard of this thing called the new normal. The new normal has been growth that's only about 2%, only about half or maybe 2/3 of what we expect. To me, the biggest threat facing the United States right now in our economy is that the new normal actually is the new normal. Because over time, if we only grow at this rate and compound it annually, and I'm talking about 10, 15, 20 years, you essentially reduce the standard of living of most of the people in this country. So to me, the most important thing about this tax package was the corporate side of it, which we're hoping is going to juice up economic growth so that we essentially demonstrate that there is no new normal. That if we get back to regular plus 3% growth in this country, you will see a lot of things change. You will see wages and standards of living go up again. You'll also see a better state and local outlook. And I have a piece coming out in our next issue of City Journal just explaining how after 8 years of expansion, what bad shape so many states are in, because the accumulation of this slow growth is really, really insidious. And that, I think, justifies taking a shot at this tax package to see if we can get back to regular growth rates above 3%. That would change a lot of things about America, or restore a lot of things about America, I think.
All right. Well, Steve Malanga, I hope we didn't get too deeply into the weeds for a lot of people, but I think it's really important.
It's complicated.
It is, but I think you've broken it down in a way that is digestible. And I thank you so much, again, for being with us on America Trends, as always. Thank you.
Okay, Larry. Take care.
All right, Steve. Thank you.